Welcome back to Insights Now. I'm David Kelly, Chief Global Strategist here at JP Morgan Asset Management. For US investors burdened by home country bias, emerging market debt has traditionally been a less familiar and underutilized segment of the fixed income universe. That being said, the sector has caught the attention of many in recent weeks. EM debt has seen significant inflows since the new administration's April 2nd tariff announcement, as global investors have begun to diversify away from US debt. This, in combination with the weaker dollar and the allure of higher real yields, has allowed EM debt to handily outperform treasuries so far this year. However, investors unfamiliar with the asset class should proceed with caution. Emerging market debt is a broad term that captures bonds issued by a range of countries, each with different fiscal situations, economic dynamics, and risk factors. By using an active investment approach, investors can identify assets with yields that sufficiently compensate for their associated risks and steer clear of those with challenging fundamentals. On this episode of Insights Now, my co-host Gabriela Santos will be joined by Janet He, Head of EM Sovereign Debt Research, to discuss why investors should consider adding emerging market debt to portfolios and key findings in Janet's recent research. If you're listening to the audio version of this podcast, you can now watch along on YouTube by tuning into our JP Morgan Asset Management channel, linked to the show notes. Now let's get started. Over to you, Gabriela.
Thank you so much, David. Janet, so for those perhaps less familiar with the emerging market debt space, how do you think about it in your head? How do you bucket it into different types of debt?
Yeah, that's a great question because it's one asset class, but really several and a very diverse asset class within that. So the typical bucketing is kind of three categories. First, kind of what currency are we talking about? We're talking about hard currency, dollars, euros, primarily dollars, or local currency. So the currencies of the country, the emerging market country itself, Mexican peso, Brazilian real, whatever it is, or corporate debt. So there's sovereign debt and corporate debt. And corporate debt, we're primarily talking as foreign investors about investing in hard currency corporate debt, so corporate debt denominated in dollars. The local currency corporate market exists, but is not really, I'd say widely invested in by foreigners. So those are the three large kind of categories that we invest in. But of that, there's 80 countries or more, depending on how you want to define it. And within those 80 countries is a huge diversity. We're one of the only asset classes where you're dealing with everything from a single A country like Qatar that arguably has better fundamentals than the United States, all the way to distressed stories that are in default, and you have to calculate their recovery value. So you really have the whole credit spectrum, as well as in the local space, both rates and FX.
That is absolutely fascinating. And across the space, those 80 countries, those three main different types of debt, but especially on the sovereign side, how has it behaved this year? We've certainly had a lot of U.S. policy-driven headlines around tariffs. How has it behaved? Has it been as resilient as the EM equity side?
Yeah. Much better than expected. So I actually went on maternity leave a little bit after Trump got elected, and one of the last things I wrote was sort of a calm your mind piece about Trump. I got some things wrong because he was more aggressive on tariffs than I think anybody really imagined.
The market, yeah.
Exactly. But what I didn't get wrong was the resilience of emerging markets as an asset class. So, year to date, I've come back now, and year to date, 25, the sovereign credit index is up 3%, which is still in excess of treasuries, which are up 2%.
And this is in U.S. dollar.
In U.S. dollars, yeah. But the real star performer that I think no one expected was EM local. That's up 8% year to date. So actually a little bit behind, but almost in line with EM equities. So EMFX has really, I think people didn't expect tariffs, they're risk off, but this sort of de-dollarization narrative to take hold, and that really helped EM currencies and the outperformance of EM local.
It's really impressive. You look across EM countries, all the currencies are up.
Yeah.
Some by, 9%, 10%. Definitely counterintuitive, maybe. And why has that happened, though? Why has it been so resilient versus, not that long ago, 2018, when we had the first trade war?
Yeah. So I think there's been a structural story here in EM that we've been trying to highlight for a long time of EM resilience and improving EM fundamentals. It's a little bit, again, hard to generalize, but something that we've been seeing is that increasingly the large EMs that do issue in local currency, they're issuing more in local currency and not in foreign currencies, so they're not reliant on external financing as much. In addition to the currency aspect, the actual investors are local investors. You go to the Middle East and Asia, and there are huge assets of money investing locally in their own assets. So they're not as sensitive then to dollar moves because they can finance in their own markets, and they're not as sensitive to foreign capital flows.
So you'll have, I don't know, Chilean debt, and then you have the Chilean pension funds buying that debt, whether they're tariffs or no tariffs, or is that right?
Exactly. The other thing I'd say is technicals are much cleaner than they were in 2018. If you look at like a cumulative chart of EM fund flows, we probably peaked around 2016. So it's been a bit of an unloved asset class for a few years. And then so I think, that sets up for actually a very good position where some surprises like what we've seen can take place.
It can still not be in absolute sense an amazing news to have higher tariffs, but less bad than expected, discounted valuations maybe helps, right? And do you think we're past tariff pain, or is there more coming? Are we getting now going to have negative surprises?
Yeah, well, I hope so, but I really I don't know. I mean, today we just got the threat against the EU, so if it's a relative story, maybe EMs are making out a bit better, but I think even taking the tariff situation we had a month ago, which was peak tariff pain, I think the primary target and pain point has been China. And so I think that's important to differentiate when it's 10 and 145 or now 10 and 40 for China versus the rest of the world, or 10 for the rest of the world, China 40, and potentially EU at 50. The relative story is, if I'm trading less with China and with the EU, that has to mean more trade with Mexico and with Vietnam and with so on a relative basis, you could actually see some EMs come out ahead because as much as this reshoring trend maybe the intention of all this policy, it's not something that's going to happen overnight.
And you can still have some nearshoring, friendshoring helping these EM economies.
Absolutely. I mean, manufacturing wages in the U.S. are about rough ballpark $20 an hour. It's $5 an hour in Mexico. Yeah. And not just the wage differential, but Mexico's manufacturers have become very specialized and very much experts in the things that they manufacture. So so it's not going to be a quick move of supply chains, which I think a lot of people have highlighted. Certainly the policy will guide us in that way towards more reshoring and nearshoring. And I think there are relative winners even in this painful tariff game. So I hope we're past the peak pain, but I would say also just the uncertainty. You never know when Trump is going to tweet next. That is also just concerning for everyone.
Right, for U.S. markets included.
Yes.
In terms of, we've talked so far about the external backdrop, what's happening with U.S. policy, what's happening with the dollar and capital flows. But you also mentioned there are, some 80 countries on the sovereign side. So how do you keep up with what's happening locally in all of these different places?
Yeah, well, thankfully, it's not just me. I have an amazing team behind me. We have about 10 people looking at sovereign research, either, between research and PMs at all of our countries. We also have a very strong corporate research team. We have a very diverse team of people from different backgrounds. So my colleague who's from Argentina, I'm going to be talking with her all the time about what's going on in Argentina because she's going to be plugged into that anyway, just given her personal interests. So I get a lot from the team. And then, we have our own sources. I've been working in this field for about 15 years now and built a connection of local networks. And where we can, we're trying to bring more AI into that, right? There's a lot of stuff out there in the world and Twitter, external websites that hopefully AI can help us sift through a bit faster.
And as you were saying, since there's so many local investors in these markets, you have to be very plugged in, right? How is the local investor feeling, which can be very different, I bet?
Yeah, I would say especially for the local currency markets, it used to be in some of these markets, like in Mexico, for example, I think foreign ownership of Mexican local bonds used to be as high as 60% if you go back like 10 years ago. Now that number is probably closer to 20%. So the local residents are the movers of the market. So, whether that's going down there on an investor trip or, chatting with them on Bloomberg, being in touch with local investors is definitely, a key part of the analysis.
And what about the local data? How good is, economic data that you need for all these different economies?
Yeah. So, I spend a lot of time on the IMF websites. So they're pretty good at collating because not only do you need local data, but you also need comparable data. So the IMF is kind of great as an initial stop for, what is the equivalent comparable data point across 80 countries. However, they also have limits. The data quality for some data points in some countries, like, a lot of people complain about Chinese data being of suspicious, quality. But there's a lot of great data in China. Like the property data in China is quite detailed, by province, by specific categories in a way that we don't get in a lot of other countries. But the frontier markets are probably where there's more of a gap in data. Time lags, Angola, Ecuador, the reporting itself, and that's where I think being active investors and having a large research presence can really help deliver alpha because our analysts will literally go down to Ecuador and say, hey, your budget hasn't been updated for 6 months. Can you give me some new figures or some new guidance?
And I think it's interesting. I find that certain countries have more data on what's important. So property in China, consumption in the U.S. Do you find that a lot of EM countries also have a lot more on inflation? Don't they? All these different inflation measures.
Yeah, I think it depends on the country. But yeah, if you go to like Colombia or Brazil, these are markets where people are used to having high inflation for a very long time and following different baskets, including food, not including food, only perishables.
Exactly.
But the U.S. inflation data is pretty good too.
All right. The U.S. does have amazing data, very timely. And for you, you mentioned talking to colleagues that are on the ground locally, thinking about all these different countries, local drivers, external drivers. So what's kind of a typical day like for you?
There is no typical day. But it's part of what I love about covering this sector and in my job. I can tell you, so, just yesterday, a day could include, a roadshow with a new issuer. The Republic of Kyrgyzstan is looking to issue debt. And so, we were meeting with them over Zoom to learn about the story because no one has looked at Kyrgyzstan before because they're a debut issuer. I also manage a team, so we had a meeting after that about talent development and different team members. We have a sort of monthly rankings process to coordinate analyst views on countries across all the different analysts on our team. So we had a meeting there to sort of check in on that process and how that's translating to portfolios. And then, maybe at the end of the day when there's no more meetings, I can do a little bit of my own work. And, I was digging into, Surinamese oil warrants and if those pricing should be, changing given new oil price scenarios.
Wow, incredible.
So it's quite varied, across the credit spectrum, different types of meetings, some, kind of management topics as well as some personal, individual contributor work.
Of course. And these meetings, when it's like a debt issuance roadshow or when you go down there, how useful are these meetings with politicians and policymakers? Is it all just selling the good stuff or how does it work?
So I think they are necessary but not sufficient. Everyone has a bias and is trying to, obviously the point of a roadshow is to sell you their debt, so it's important to get a variety of opinions. When we do go on an investor road trip, we will meet with both official sector government officials as well as private sector analysts or industry experts so that we can get a more well-rounded view of what's going on in the country besides just sort of the government line.
Yeah. And when you put all of that together, what are your highest conviction views right now?
Yeah. So, I mean, we talked a little bit about it on the, so maybe, okay, at the sector level, we do think that the tariffs and the noise will have some sort of growth impact. And so that does lean us a little bit more to favor rates versus, say, credit on margin. I think the dollar weakness has also kind of given the green light to a lot of central banks to cut more than we maybe initially anticipated at the beginning of the year or thought that they would have space to cut. So I think this supports overall kind of local EM debt as an asset class. But even within credit, we think there's special opportunities. Some of them I've talked about, just relative tariff winners. I am quite optimistic on Mexico as being a relative tariff winner, and the new president down there, President Sheinbaum, I think has been kind of proving the right micro strategy, being very pragmatic in how she is working with the companies within Mexico, and also being very cautious on the fiscal side, at least relative to expectations. So yeah, I think Mexico and also even some Central America stories also stand to benefit from sort of this relative trade dynamic.
Mm-hmm. And in terms of appetite for the asset class, have you felt the shift? Are investors noticing this good performance?
Oh yeah. Well, so again, it's been challenging for fixed income flows for quite some years, not just EM fixed income, but broad fixed income flows for the past couple of years in terms of outflows when we track sort of mutual fund data. Year to date this year, the hard currency EM funds are down about $8 billion, so $8 billion in outflows. But the local currency funds have seen about $7 billion of inflows. So sort of this. Maybe it's chasing performance, as you said. A lot of that has also gone into Asia, so it could be sort of that de-dollarization or diversification theme. So the appetite for sort of these dedicated flows to dedicated mutual funds hasn't been that strong. I'd say stabilizing after a couple years of outflows. But again, I think the makeup of the investor type is completely changing. Instead of a dedicated fund, I think more people are getting EM exposure through as crossover investors. So maybe you're a U.S. Ag or an income fund, and you're getting your EM exposure that way. And those actually are ending up being some of the largest players, I think, in EM debt now.
Interesting.
As well as the local investors that we talked about, the Chilean pension funds or the Middle East wealth funds. Those are kind of bigger players versus just the dedicated emerging market debt funds.
That's interesting. That's super interesting, and especially with that juicy real interest rate, it certainly makes sense to have crossover, right, for some fixed income strategies. Yeah,
and I think the de-dollarization story has been covered for some time, and we're still figuring out to what extent it's happening. I don't think it needs to be as big of a theme as de-dollarization for emerging market debt to do well. It's just diversification. There's been this huge overweight to U.S. markets. So, hey, if I look at my portfolio and instead of 80% in U.S., I'm now just going to be 79% in U.S. Even that 1% move could be quite meaningful across the board for EM assets.
Absolutely. Yeah. Now it's time for my favorite part, the bonus round, where we get to ask you for recommendations. If we want to keep up with all the good, the bad, and the ugly of emerging market debt, what would be maybe one book, podcast, movie recommendation you make, and then also one within JP Morgan that listeners could follow?
Yeah. So podcasts are great, obviously. One, I think, specific to maybe emerging markets that I've spent more of my career looking at Latin America, and the Americas Quarterly does a great. I mean, they have a written piece as well, but they do a great podcast where every couple of weeks they kind of drill in deep on a topical issue within one country in Latin America, and I think it's great for kind of getting a kind of political pulse on all the countries in Latin America over time.
Say the recommendation again.
America's Quarterly.
America's Quarterly podcast.
Yes.
Oh, I like it. And one JP Morgan one that you'd recommend?
Yeah, I guess the GFIC blog is one that I contribute to from time to time. I mentioned, my blog on Trump. But in particular, there, Bob Michael, our CIO, does a piece every year at the end of the year on realistic surprises for the next year. And his last couple for EM have actually been spot on. They're supposed to be things that maybe have like a 30% chance of happening. Like, they're not expected, but because they're not expected, they might move markets more because they're realistic. So the one, I think, 2 years ago, he had EM sovereign, and this was when people were very pessimistic on EM. EM sovereign upgrades could outnumber downgrades, and that ended up happening, and we told them it would happen, and it happened. And then last year, also unexpected, he said EM local currency would outperform, and lo and behold,
Here we are.
Here we are. So.
And we did get tariffs that were much higher than expected.
Yes, we did.
Amazing. Thank you so much, Janet. It was wonderful having you on the podcast and all things emerging market debt. And importantly, thank you so much for listening and watching. And please make sure to check out the rest of our episodes. This season, we've been focusing on interviews such as this one with all of our fabulous fixed income research analysts. Thank you, and we'll see you soon.